Hello and welcome to this Field Seymour Parks webinar on IR35. My name is Ian McRae. I'm a partner here in the employment team, and I'm going to be taking you through a number of different aspects of IR35 in 3 different instalments. So we're going to be starting off by looking at the current status of the law. The second part of this webinar will then look at the changes that are coming in for the private sector in April 2020. And then we're going to finish off in the third part by looking at some contractual issues and things to consider in respect of existing and new contracts that might be caught by the regulations. So let's get straight into it. What is IR35? Well, it was introduced back in the 6th of April 2000. And IR35 is actually just the name of the press release that originally announced these regulations. And the law is actually contained in a number of different areas. But for the sake of simplicity today, we will just talk about the IR35 regulations. So it was introduced in 2000, and the aim of it was to crack down on a perceived form of tax avoidance. So the government believed that individuals were essentially avoiding paying income tax and national insurance contributions by supplying their services through an intermediary, which most commonly was a personal service company, so a company that was wholly owned and indeed controlled by an individual. And then that individual would pay themselves in dividends from that company, thereby avoiding the income tax and PAYE deductions that would normally need to be made. So that was the reason it was introduced, and I'm going to take you through briefly now in this first section about the current position in the private sector. So in very broad terms, when do we have to worry about the IR35 regulations? Well, in simple terms, there are 3 conditions, 3 elements. Firstly, you need an individual who is performing services for a client personally, or they can be obliged to perform them personally. So there's a personal service element. That's your first test. Second element is those services have to be provided via an intermediary. And we'll go on to look at what an intermediary might be in a little bit more detail. And then finally, and the one that always causes the most issues, is whether or not that worker would be deemed to be an employee for tax and national insurance purposes, if it were not for that intermediary in the middle of that contractual relationship. So those are broadly your 3 tests. Let's look at them in a little bit more detail. So firstly, let's have a look at this idea of an intermediary. Well, it can be a company, which is the most common form. It can also be a partnership, and in rare circumstances, it can even be an individual. And ultimately, it is where the worker receives income from that intermediary that is not taxed as employment income. So as I said earlier, often paid in the form of dividends. It can't be an associated company of the client, so it can't be a member of the end client's corporate group, parent company, subsidiary company. That wouldn't qualify. And there are specific requirements that are set out in detail in the legislation about when one of those intermediaries will qualify within the regulations. And in the slide, I've given you the details of 2 of the key elements when we're dealing with a company. So where the worker has a material interest in that intermediary, a 5% shareholding or above, or where the payment received by the worker can reasonably be taken to represent payment for the services provided by the worker to the client. Either of those will mean that you trigger the company qualifying as an intermediary within the IR35 regulations. But ultimately, the test of whether or not there is an intermediary is relatively easy to establish because it's quite prescriptive in the legislation. Let's have a look at it in its most simple form, its most common form. So as you can see, I've set out in very basic graphic representation in the slide here how this most commonly comes about. So at one end of sort of the contractual change, you have the individual who is going to provide the services. They have a relationship with the intermediary, which most commonly is their personal service company. So a company which they will have 100% shareholding and also will control. So they may be the sole director of it as well. And then that intermediary, that company, has the contract with the end client. So the client's contract is not with the individual themselves, but with the individual's company. And then what will most commonly happen is services will be provided by the worker to the client. The intermediary will issue their invoice for those services to the client. The client will pay the intermediary, and then the intermediary will make a payment to the worker. And if it's outside IR35, that may be drawn down through dividends. So that's in its most common form. In part 2 of this webinar, we'll look at it where we've got a longer contractual chain, but this is the most simple example. I need to be clear in terms of some relationships that aren't covered by IR35. And the most obvious one is where the individual contracts directly with the client. So there is no intermediary company involved. It is Joe Bloggs, the individual, having a contract with the end client, and there are no other parties involved. That will not fall within the remit of IR35. You may still have issues in terms of whether or not there is an employment relationship there. Is it correctly classified? But that's outside IR35. Equally, if you are an agency worker and that agency worker is employed by the agency, then again it's outside IR35. And the very simple reason for that is that if the agency worker is employed by the agency, then they will be paying normal income tax and national insurance contributions, and therefore the taxman will be getting his share. So that again is outside IR35. Managed service companies are subject to a separate legislative regime. And umbrella companies, much like agency companies, where the end worker, the end employee is taxed in the normal way, so where income tax and PAYE deductions are being made, somewhere in that chain, then again it falls outside the IR35 regulations. And then the final one I will make the point of, but hopefully should be obvious, that if someone again is a direct employee, so that you're a classic employee, employed by the end client, paid by the end client, and those tax deductions are made, then again outside the scope of IR35. So that's it in its most common form. There's one other thing I want to pick up on as a word of caution, which relates to directors, and principally non-executive directors, so non-employed directors. And they have also potentially been affected by the IR35 regulations since April 2013. And there are two ways in which they can potentially be affected. The first one is just a twist on that classic test which we have just looked at. So would the worker have been an office holder? Would they have been a non-executive director were it not for the intermediary? If the answer is yes, then again IR35 may require those tax deductions to be made. The other one is a little bit more nuanced, and this really covers a situation where a non-executive director has two hats. So they may, in their personal capacity, act as a non-executive director for a company and draw directors' fees which are subject to PAYE deductions. So that would be their first hat. But they may also provide consultancy services via an intermediary, so via maybe another personal service company. And for those, they may invoice for them and be paid without any deductions. Now, the risk with those arrangements is if those services that are provided through the personal service company are linked to the directorship services, then again, IR35 may catch that arrangement and require deductions to be made. So in simple terms, if you've got a non-exec director and they have a non-executive directorship in a personal capacity, but they're providing services that are separate to that via a personal service company, then that's something you need to look at quite closely, just again to make sure that there are no IR35 complications. So moving on from directors, I'm going to look at this third limb of whether IR35 is triggered. And this is always the most difficult one. And this is the idea of deemed employment. So would the worker be deemed to be an employee for tax purposes were it not for this intermediary company sitting in the middle of this relationship. And I guess the first thing to note here is that actually the tests for whether someone is an employee for tax purposes and whether they are an employee for statutory employment law purposes are not identical. They're not exactly the same. So somebody could be an employee for tax purposes but will not qualify for statutory protections, and in theory vice versa, although there are a number of similarities. And those of you who are familiar with employment law will be aware that there are generally three classes of people who provide services under an employment relationship. So you have the self-employed, you have a worker, and you have a normal sort of employee. For tax purposes, it is purely about self-employed or employed. Worker status does not come into it. So I'm going to take you through briefly some of the factors that will be taken into account when determining whether someone is a deemed employee for tax purposes. And the first one, and the one that always gets a lot of publicity, is the idea of personal service. And this always used to be sort of seen as the silver bullet to avoiding deemed employment status, which is the idea that you could appoint a substitute. So instead of you performing the services, you could require somebody else to provide them for you. And the reason that was always seen as a factor towards self-employment is that the employment relationship is very much a personal one. It requires you to perform the services rather than just anybody you may choose. The difficulty with that is there are all manners of grey areas with substitution, because at one end of the scale you can have an absolute right to appoint anyone you want to perform the services, but increasingly that's quite rare because often the client will want approval of who you're going to appoint, or they'll need certain conditions or qualifications before they can provide the services. Or maybe substitution is never actually going to happen in practice. So it's not always quite as straightforward as it might seem. Second factor to look at is the idea of mutuality of obligation. So traditionally this was the idea in employment that an employer has an obligation to make work available and the employee has an obligation then to do it. HM Revenue and Customs have a slightly different approach to mutuality of obligation than previous cases have decided, and they actually believe that mutuality of obligation occurs in every single contract, self-employed or otherwise. But you will need to look at whether or not there is an obligation to give work to an individual and are they obliged to do it when offered. Control is another factor. To what extent does the individual have the ability to choose when, how and where they perform their services? Is it entirely up to them and they're judged by results, or is there much more restrictions on how they perform their services for the end client? Substitution we've looked at in terms of personal service. Equipment, traditionally self-employed individuals would provide their own equipment to provide the services, and increasingly that's not just about providing tools or something of that nature, but maybe it might be software, access to premises, all those types of things. Financial risk. Self-employed relationships traditionally involve more financial risk, so whether that is working on a fixed fee without knowing how long the project is going to last for, or maybe having an obligation to rectify mistakes that have been made at their own cost. But increasingly there is, traditionally there is a greater importance on self-employed people taking a greater financial risk. Length of the engagement. Again, traditionally a self-employed relationship is project-based or fixed term, with employment being something that is ongoing. Integration into the end client business. So does the worker have their own email address? Are they on the internal phone system? Are they on the website? The more integrated an individual is into a business, the more it will look like an employed relationship. Benefits, fairly obviously employees are entitled to certain benefits, some of those statutory, so for example holiday pay most naturally, so you wouldn't expect to see anyone self-employed qualify for that. You should also look at other things, those sort of fringe benefits that employees may get, so use of the canteen, use of the car park, getting to come to the Christmas party. All of those things can potentially be factors that will point towards an employment status. Termination of a contract, well, if you've got a traditional self-employed relationship and there's no obligation to give work and no obligation to accept it, do you even need a termination clause? Termination clauses obviously are traditionally in employment contracts. And then the other factor that I would mention is the intention of the parties. And I think you should be clear here that even if both parties believe and want the relationship to be self-employed, that does not mean that it will be classified as that. HM Revenue and Custom will want to look at the reality of the relationship to see if there is a deemed employment status there, even if both parties are saying this is self-employment. The other thing is to be aware that the revenue take into account all these factors and all the circumstances surrounding the relationship when deciding whether there is deemed employment. So one of these factors is unlikely to be conclusive on its own. So that's employment status or deemed employment status. What does it ultimately mean if the IR35 regulations bite? So as things currently stand, the sums that are received by the intermediary should be treated as employment payments to the worker for tax and national insurance contributions. The personal service company or the intermediary is under an obligation to assess itself whether there is deemed employment and account for tax and national insurance contributions. And there's also this accountable end of year process which allows for a 5% deduction to cover general expenses. But the current position is that the liability for this sits with the intermediary, with that personal service company, and not with the end client. And in part 2, we'll look at how that is going to change for some organisations. So a few final points to note at the end of this part 1 of the webinar is obviously the usual caveat applies. This is only a very brief introductory summary. You should always take specific legal advice on your own circumstances. We will be producing updates on this area and indeed other legal developments regularly by email, and if you have any interest in receiving those, then please let me know. They are free and are a practical guide to changes that are coming up. Please also do get in touch if you have any questions or comments on the webinar. My details are on the slide there, and also please check out part 2 where we'll be looking at the forthcoming changes and part 3 where we'll be looking at contractual issues.